Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us on a day when the market has rebounded from the fears, the trauma of Trump's tariffs. So the big question is, should we be investing now or should we be keeping our powder dry for a sell-off and maybe buying when the opportunity is better in the future? To find out the professional's view, we've got Junbei Liu of 10Cap, that's a fund manager by that name, and Paul Rickard of the Switzer Report. Coming up first is Junbei Liu. Let's cross to her now. Well, Junbei Liu, lots of people are worried about Trump tariffs. What's your view? Is the buying opportunity?
Look, this is absolutely the buying opportunity. Trump is doing the tariff for three reasons. One is to equalize the trade imbalances. Two is to drive the political outcome and certain things that he wants out of those economies. And then the three is to protectionism for example, the steel industry. And then he will do, and then his headline will be really very much depends on what he get out of those three things. The overall, we've done analysis. Overall impact on those economies from those tariff proposed is not very large, let alone worrying about global growth being impacted by those ones. I think the overall impact is very small. Overall impact from the current one is small also on inflation as well there in the US. So it's absolutely a buying opportunity.
Okay, let's move on from the tariffs, given the fact that you're saying it's a buying opportunity. The inflation number the Americans got on Friday, it looks like another positive for US stocks.
Yeah, look at it. Absolutely. I think the overall U.S. growth is not doing too badly. At the same time, they are weakening somewhat. So, so the good news is 2 weeks ago, we thought there's only one more interest rate cut to come through for the U.S. Now it's been pricing to 2 to 3, and that's good for the U.S. stocks. While the economy is not collapsing, so if it was 6 months ago, this would be taken very positive news. However, I think at the moment, investors just having a bit of a sort of pause to take a bit of profit before we start again.
Yeah. Okay. On that subject, you touched on growth. I guess this week's economic data is pretty important in the US, particularly the jobs report on Friday.
Yeah, that's right. So all eyes are on the job report. Look, given every other data we've seen so far has weakened from the super strong level. It's not collapsing, just slightly weaker. We do think that this might potentially show some weakness. If anything, this will add to the more high conviction that more rate cut is coming through. So investors just need to remember, if the data weakens, Fed will cut the rates. If the data is strong, there will be a little bit less rate. So net it's positive for the market.
Okay, let's go local now. Interest rate cuts here. How many are you expecting this year?
Look, we're expecting at least 2 more to come. So we already had 1 and 2 more to come, and not more. Our data has been pretty weak. We've seen it through coming through sort of every component of the corporate results. The corporate result has talked to pretty tough margin conditions. So so we do think that we will have more cuts to come through, and in turn, it's actually placed us much better compared to the US markets.
Right. I don't know how you operate in your life, Junbei Liu, but I know when a stock that you like does well, I say to myself, oh, Junbei Liu was talking about that one. That's one that she really likes. Well, over the last week or so, 3 stocks that I continually ask you about, and that's because I'm invested in them, namely Audinate, Megaport, and Tyro, all did well after reporting. And I think part of it was the short sellers got caught out a bit. But what was your take on those 3 companies in terms of their reporting and the fact that they've done so well when the market's been down? Is that a positive sign for those 3 companies?
Look, I do think so. They got way too cheap. And then, like you said, there's way too many short sellers sitting in them betting on a very poor result. And most of them, particularly in Megaport, has actually reported really good results, has resulted in pretty significant upgrade to earnings. And it has shown and demonstrated green shoots that's appearing. In the case of Audinate, I think just that they have demonstrated things have stopped getting worse and they managed to get a bit more software sale instead of the hardware. And they're working through through the current issue. So look, I do think the market is turning. Some of the winners are really being sold off this reporting season to really fund some of those laggards.
Yeah. So is it fair enough when I argue, when people ask me the question, that probably over the next year or so, a lot of those big winners like the banks and Wesfarmers and all those sorts of great companies may well lose a bit of share price, while the companies that will benefit from lower interest rates become more attractive over the next year or two?
Definitely. That's absolutely is going to be the theme for the next 12 months.
Yeah. Okay. We call that rotation. There's a few companies today, and there's a company you like, Goodman Group, a positive reaction in the market today. But of course, it is priced to perfection. But is this a company you're happy to buy even at these levels?
Yeah, I definitely want happy to be by Goodman Group. Not only is it executing very well with its core industrial portfolio, it's also converting its industrial pipeline or existing industrial property into the data center. Just raised a lot of capital, $4 billion indeed, from investors to really realize that pipeline. And in the next 12 months, in fact, they will become the biggest data center operator here in Australia. And there's just incredible momentum going for this company. And that $4 billion capital raising literally it disappeared, and the investor couldn't even get enough of it. So, I do think that's a good core sort of holding for anyone's portfolio.
Okay. I'm going to ask this question because I don't know every one of your holdings, but do you hold Macquarie?
I do, and I do think Macquarie looks far better than other domestic banks at this stage. It's less expensive. It's got a global growth thematic to it, and it's leveraged to the transactional, the merger, M&A activity picking up. This company, definitely put that ahead of many other banks.
Yeah, because my problem is it's an important stock in my portfolio, and a lot of my clients as well in financial planning. But the thing is this, we know if the US market really has a big correction, Macquarie will suffer. But if the US market keeps climbing up, Macquarie will keep climbing as well. Is that a fair call?
Oh, absolutely. Macquarie absolutely will follow those. And remember, the US bank is expected to do quite well this year because the Trump talk about deregulation. And that's very positive for market transactions and activities. And I do think Macquarie is very much leveraged to it.
Here's a company I don't think you necessarily would follow, but Domino's beaten up again today. Is this ever going to get in the buy territory for someone like you?
Oh, I do think so. I think it's getting to that point where, it's interesting to be looking at it now because, look, things are very tough. But what they've done is that they rationalize a lot of stores, unprofitable stores. So things should get better from here. But of course, market wants more evidence of things getting better. Overall, sort of fast food category is still pretty tough. I do think it's within the next 6 months. Here's your buying opportunity.
One last question. What is the company that you think reported really well, and as a consequence, you suspect is going to do well on the stock market over the next year or so?
Yeah, so there's a lot of them, but the one I'll point out is A2. Incredible result. Earnings, revenue managed to grow 10% when the market was down 6% over there in China. And then they guided to accelerate a growth like 14% revenue for next half. And the company is not super expensive with $1 billion on the balance sheet. I think it's a business that's share price will be well supported.
Well, I think history will record that you are definitely a pick and stick kind of fund manager.
That's right. That's right.
Great to see you, Jimbo Liu.
Thank you very much, Peter.
And that's Jimbo Liu of 10Cap. And that was Jimbo Liu of 10Cap. And now Paul Rickard joins me to talk about the key issues around tariffs and whether we should be investing now or should we be waiting. Paul, thanks for joining us, Paul.
Thanks, Peter.
I think it's an important time to tap into the way you're thinking because there are a few challenges. Last week, I got to say the actual percentage fall wasn't all that great, but it seemed like a lot of negativity, particularly in the US.
Yeah, I mean, look, it was interesting just if you look at the result in February, our market was off 3.7%.
Wow.
It's actually pretty well flat for the year, or a little bit of an up today.
Yeah.
So all the gain we had in January, we've given up.
Yeah.
And that happened in the same week that the European markets made records. US had a slightly down week, but we're probably a little more negative than at the moment than perhaps in other parts of the world.
Yeah, I think I looked at the 6-month return. It's like 0.8%. It wasn't. It's really. But I feel as though as long as these tariffs don't hit our best customers all that hard, this could be a buying opportunity. And Junbei Liu, who was just on the program, she thinks it is, but she's often very, very positive. But you tend to oscillate between being bearish and a little bit bullish. So, how are you feeling?
I'm a little cold. I mean, I guess there are three reasons. One is that our reporting season was a little weak. Perhaps a little more conservatism in terms of what people were saying. So it's hard to see just where some of the earnings growth comes from. So that's probably the first reason. Secondly, I just think the what's going on internationally is just so hard to comprehend. And you've got to feel in that environment that given markets have bought the Trump rally, you've got to feel that they might just have a little bit of, I won't say a pause for concern, but want to see some delivery before they get too carried away. And then thirdly, just in terms of some of the other things going on, I mean, tariffs probably negative for Australia, question mark. Maybe the data coming out of the States shows the economy there is slowing a touch.
Yep.
Talk of stagflation, so maybe tariffs being a little bit inflationary, growth falling. Allegedly, President Trump not too worried about if there's a bit of pain in the economy while they, toss a few people out and get the budget deficit back in order, as if.
So made that promise for a long time.
Yeah, and then look, there are some very bearish people out there, and it's sort of, I guess, they impact you a little bit. And while they're very bearish, it's important to remember that equity markets are still pretty high.
Yeah.
So I'm a bit cool, and I think we're going to see better opportunities, but I'm just a bit wary that I'm getting. You can get too suckered into this to think the world's about to end, and it's probably not going to.
No. Even someone like Shane Oliver, who I think is genuinely bullish, and he does think markets go up this year, he wouldn't be surprised if there's a 15% correction. That's pretty big. I wouldn't be surprised if 7 or 8% if this tariff stuff gets more and more scary. And I think I would then be a buyer if that's the case. So what is worrying you? I've got tariffs, US inflation, US growth, all three, or mainly the tariffs?
Look, mainly, I think mainly two, tariffs, and then what I'd call maybe the risks of stagflation, which I'm not necessarily making a case for. I know people are now talking about because they're saying tariffs are going to be inflationary. There's not a lot of growth coming, and the Fed was already worried about the sort of inflation. Sort of found a bit of a base, and it was really a bit stickier than that. Wasn't so long ago we were talking about the stickiness of inflation. So that's the international scene. Locally, an election here, hung parliament. Elections are always slightly negative for markets. Hung parliament, maybe that could be the worst outcome. I think I do agree. We want to see some productivity growth. We want to get Australian businesses firing again, and it's just not there at the moment.
Yeah. I saw Ross Gittins blaming bosses. Anyway,
well, maybe there's something in that, right?
That's an argument for another day. All right. Also, the rotation. That I tried to talk about in the Switzer report today, that when you get rotation, some of your great performing companies, they're going to be falling in price, and they, in a sense, drive the index down because they're so big. And the little ones who are now coming in favour, and I talked to Junbei Liu about Ordinate, Megaport, and Tyro, three companies that I've liked have been struggling. They've had a great month, fantastic month on the rebound. Do you think the rotation also leads in the short term, depresses the index before they stop falling, the big ones, and the little ones start taking off?
Yeah, look, it does a bit. In fact, small caps overall did a little better and have done better the first 2 months of the year. So the X20, trade that you've been looking at, that's all right. I mean, the year to date to February, the large caps are down, I think it's just over 4%. The small caps are up only down 1.7 or something. So it's about a 2.5% swing in favour of small caps over large caps. It doesn't sound a lot, but it's actually relatively significant.
And it's the start of something. It's a new trend.
It's the start of something. So I should say large caps are flat basically, and small caps are up about 2.7%. So I think the other thing of rotation, you're going to have something to rotate into. I'm sure a lot of fund managers would like to rotate out of banks. The obvious thing to rotate into is resources, and they're scared to. There's probably a good reason, because we're just not seeing any upward movement in commodity prices. And nor are we seeing a lot of love for things like the health sector, which is the second biggest sector after that. And that's mainly, I think, function a little bit of, some company-specific issues, CSL, Cochlear. Maybe people just got down on health after such a great year. So that's why that's where the rotation argument sort of breaks down a little bit. You've got to believe there's something you want to go into. And at the moment, apart from a bit of the small caps, I don't know whether there's a lot of sectors that people are crying out to invest in.
And I guess it's fair to say we're not sure how many rate cuts we're going to get. If we're absolutely certain there's 3 more coming, I think they'll be buying of those stocks. They're going to be dead set beneficiaries, but we're not sure at this stage. So maybe that will change. Also, China has this, I'm sure you've been reading, 2 sessions. Now, there must be actually 2 meetings, but out of these 2 sessions, which is done in March, we could find that China's going to go for some big stimulus. That would be a great thing for our market, I would have thought.
That would be a good thing if it happens. And look, let's just wait and see. I mean, China's, of course, we're so dependent on that in our resource companies and our managed services companies. So we need to sort of see that. But look, let's just wait and see how that plays out, because there is also suggestion they're going to reduce their growth estimate down to something a bit more, probably closer to what it actually is. But
that'd be nasty.
That'd be nasty about Chinese statistics. Yeah.
All right. So here's a question. I'm getting personal now. Are you selling?
No,
or you're just waiting?
I'm waiting. I haven't. I did a little bit of. I've sold a little bit into the bank rally, and if the banks come up again, I'll sell more. But I haven't really seen a lot else that's worth selling. I mean, I think there are a lot of. It's the banks and some of the stocks that have been in high demand, and things like JB Hi-Fi, Wesfarmers. They're the stocks that look expensive. The rest of the market, there's a lot of very cheap stocks out there. So, and I haven't been selling, but I have been just a little bit cut back on banks.
Okay, let's get very personal. I know you can't mention Tyro because you're on the board, but both Tyro, Megaport, and Audinate were all stocks that were the short sellers have been picking on. They reported a better than expected, and the market really took off. But of course, then there's selling. Do you think with some of these stocks, there are people that, for example, when they see Tyro at 80, think, I'll buy it at 80, but when it gets to 90, I'll sell.
Unquestionably, I think
it's a great play thing for some stock players.
And I think you got to have the catalyst to take it to a new sort of price level.
A really big story.
A really big story. And to be honest, in all fairness to Tyro, I don't think we had the catalyst there. The others, Audinate, I don't also. I mean, I think it was better.
It was better than expected.
It had come down a long way and it wasn't as bad. The stock that still seems to be on everyone's lips is still, not WiseTech, is well, it is on everyone's lips, but is still Pro Medicus.
Yeah.
That had
up to date.
Yeah, up to date. That had quite a bit of a fall last week, but it's bounced back quite strongly today. It just sailed through $200 without stopping. I thought it'd have a breather at $200. It hasn't quite got to 300. I think it's 298 something or other.
At what level didn't you buy it?
I didn't buy that 120 when I got really keen on about it, and I'm still kicking myself and watch that stock every day. Some stocks that I like, Pete. I really like Telstra, but it's had a big rally. It's up. It's up. If you add in the dividend, it's up over 10% since it reported. I'm starting to think that's about, Telstra about 440 is about where it could go to. I'm not sure.
You don't have to sell it. You just don't.
I just don't.
So
I think I think the value's gone out of Telstra to an extent. Still like car sales, which is hanging in there. Next DC looks interesting. It's come off a long way. It's sort of got caught. It was probably the first company to get big time into data centers, but now everyone's into data centers, and Goodman raises money, and of course that sort of means people just get out of some of the others to fund that. It's now at about $13.60. That's starting to look interesting.
I want to own both Goodman and Next DC.
Goodman, if it comes off a lot more. It's interesting. I think one of the questions I think a lot of fund managers might have is when these companies do big raisings, the stock price just sinks afterwards, right? I mean, it's Goodman, and they all lined up to buy it at $33.50. Last week it was down at 31 something. Just shows you that what happens when you get a lot of stock. It takes many months for the for the market to digest it. So you sort of wonder why you participate as a fund manager in some of these raisings.
Yeah, I guess you probably would have been happy to participate in anything with zero in it because it's kept going up.
Yeah.
You're right. You're right. It often happens. If you had cash now, would you hold and wait for a bit more of a sell-off and then go in there?
Yeah, I think particularly given our local environment of an election, I think it's just time to be on the sidelines a little bit. You know, if you're well overweight what you should be, maybe do a little bit of pruning. But I think it's too early. I don't think we've really had the correction yet. Now, maybe we're not going to get it. But maybe you just got to be patient and be prepared to say I was wrong. But I think there's a lot of sort of clouds up there, and let's just see what shakes out of those.
So if you were historically a 60-40 investor, 60% growth, 40% defensive, but because you've done so well, you've gone to 85-15, would you be selling some of your growth and pulling back?
I'd be just taking some off the table, I think. But I think that's prudent. It's look, you're never going to be 100% right. And the trouble with taking a profit is markets do tend to go up over the long term, and that's what any investor's learned over the last 150 years. But they also have sharp pullbacks, and I think sometimes you need a bit of room. And I feel we've had a good rally, more so internationally than Australia, but a good rally leading into it. A lot of money riding on the delivery of Trump's agenda, largely through deregulation, what that's going to mean for US companies and earnings and so forth. But I think you got to start to see the delivery. You know, there might be a bit of pain in the meantime, particularly as we go through these adjustments with tariffs and maybe question mark, a bit of stagflation.
Okay, so my view is provided the tariffs don't become so worrying that Wall Street has a big sell-off, Australia could look forward to two potential positives. One would be more clarity about how many interest rate cuts we get.
Yep.
So if there's a gradable, if there's...
And remember, Michelle book largely didn't take it off the table, but she said it's going to be pretty hard to cut again, right?
She was very stingy.
Yeah, she was
very stingy. But then if China also comes with a good stimulus package, put those two things together, then we might play a bit of catch up, and that would be really good for BHP and Rio, and that's what we need. I think.
Yeah, I mean, if you could get excited about resource stocks, then I think you can get a lot more excited about the market. Yeah. And I know, and the whole market's not resource stocks, but we've got the bank sector so expensive.
Yeah.
It's really hard for the rest of the market to sustainably go up.
We need big players, don't we?
We need the big players to sort of show the outlook to be a lot more promising for the big mining companies.
Okay. That's Paul Rickard of the Switzer Report. And that's the show for tonight. Thanks for joining us. Don't forget, if you want to become a member of the Switzer Report, just go to switzerreport.com.au. Thanks for joining us. See you next week.